We saw the markets, equities push up through the week, and they were concerned about China. And then at the very end of the week, President Trump gave a news conference and said, we're really going to go after China with a lot of sanctions. And what did the equity markets do? Well, apart from the Dow, they actually went up.
Well, this is a very unloved equity market rally. Investors were holding their breath all week, waiting to see what would happen between the U.S. and China. And really, it wasn't anything that was unexpected. We did not see any increased sanctions that were material. The phase one trade deal is still in place, and investors blew that off and kept moving. And that's kind of been the case. There's a lot of good and bad data for investors to try to analyze right now. On the good side, we have hope on vaccines. We have regional reopenings that are leading to upticks in economic data. But on the downside, we have to worry about a second wave. And also the consumers who led the last bull market led us into the shutdowns, and also will be the one who leads us out. And we're not seeing a significant pickup in consumer spending. Actually, we're seeing saving rates increase. So, and then you look at the markets and they've priced in a lot of that good news. So now I think investors are going to become increasingly worried if U.S.-China tensions actually accelerate from here, or we start to see other bad signs. I think it will be time for the market to roll over in that case.
Well, that's interesting because we've had 2 months in a row now. We're at the end of May. We've had 2 months in a row now of the S&P being up rather substantially. And yet people keep saying, well, the economic numbers don't really justify it. At what point should we begin to believe the equity markets rather than the economic numbers?
Well, if you look at what's working in the equity markets, for 80% of the time this year, it's actually been growth stocks, which really is a sign of quality working. So the markets aren't necessarily believing the economic numbers either. If we started to see a real sustainable pickup in cyclical companies, which are very cheap, we did see this for a few days this week, then I think you'd start to believe that people are looking for economic strength. In order to see that, we'd want to see maybe really positive signs on a vaccine. If we could get a vaccine in place sooner than expected, maybe we'd see even stronger than expected economic data. But our view is that over the long run, it will still be a quality growth kind of environment where those companies which are less levered to the economy will continue to outperform like we've seen basically for over a decade now.
So it wasn't just cyclicals this week, it was also small caps and to some extent EM, emerging markets that came back. Does that tell us anything about this rally, or do you think this was just a fill-up, just a one-off this week?
Well, another thing we've seen that's a positive for non-U.S. markets is a weaker dollar. So that's another support for non-U.S. markets. We actually are positive on emerging markets. They've been laggards over the last bull market cycle. They were underperformers going into the COVID-19 environment that we saw. And one area that really got hit hard was Latin America, one of the worst performing emerging markets. And we actually think that, somewhere like Brazil, which is behind the curve with COVID-19 and struggling with geopolitical issues, they could hit an inflection point with some global economic growth, and that reform story that was in place before we had all of this turmoil could come back in. And that could be kind of a very out of consensus place to look for strong companies that are surviving the crisis over there.
So was your basic take, Saira, that we're still in the world of, I think they're called stay-at-home stocks, a lot of those tech stocks, which we're all using with all of our electronic paraphernalia at home, that really is the place to be if you're an investor? It's too soon to go back into some of the things that were really beaten down badly by the pandemic.
Well, we're looking more for barbell portfolios. The interesting thing about these technology companies is the stay at home in this environment actually accelerated trends that were already in place. So trends to digital, online, working from home, all of that was already in place. It's even stronger for these companies now. And trends on the negative side, such as brick and mortar retail, actually have gotten worse. There's other trends that I think are going to kick in because of this environment. One is going to be shorter supply chains, more localization rather than globalization, higher inventory levels, higher food safety levels. Even autos could become interesting on the cyclical side, as people may choose to shun public transportation and go away from more of a sharing economy and more towards having their own cars again. So there's a lot of trends in terms of quality that you can play, not only from growth, but also to value. Another interesting area was actually ESG. Companies with strong ESG practices, environmental, social governance, actually tended to outperform in this environment because they tend to be more heavily indexed to quality.
At the same time, is there something of a divergence within the tech sector between, on the one hand, sort of, I can say, at the infrastructure tech as opposed to the consumer-facing tech? We know that President Trump has really gone after Twitter and the social media more generally this week. Do you see two different sorts of characteristics of tech right now?
There are definitely going to be tech winners and losers. We've seen a lot of technology companies hitting new highs. Social media, I think, has that regulatory dark cloud on it now. Premium valuations, that's not an area we'd be looking to until we get more clarity on whether laws would actually be changed when it comes to how they're regulated. Tech companies that benefit from the cloud, from working at home, from online practices, we think those will only get stronger. But then some tech companies that were benefiting from more of a sharing environment, those may be now structurally impaired for the time being. So you definitely need to be selective within technology. And also, if you look to value, which again, very cheap, which could have a comeback, you want to again stick with quality value. Companies with strong free cash flow, strong balance sheets that are going to be survivors in any kind of volatile economic environment, because the economy is still unclear right now in terms of could there be a second wave and how fast will we really reopen and come back to business.
Saira, how do you sort out what's real, if I can call it that, as opposed to what is the central bank? We had Fed Chair Jay Powell again this week saying he's willing to do whatever needs to be done. How much of the valuation in the market right now is really just central bank liquidity?
I think that has been a real support system for this environment. If you look, we've had almost 450 global stimulus measures in the last year, from rate cuts, quantitative easing, and just flat out stimulus. And that's a very strong message for the market that this will continue. If we see a second wave, if the economy remains very rocky, we do have the support from global central banks. I think that's a very positive for the market, and to help provide that support and that faster than expected comeback that I think most investors were not expecting to see.
Finally, briefly, Saira, if you want to hedge against the possibility of something of an uptick, a second wave, what do you go to?
I think then you're looking very much into quality growth, such as healthcare companies. These are going to be other beneficiaries. If you're worried about a second wave, healthcare companies, not only the ones producing vaccines, but people are going to be more focused on wellness. There could be food safety companies. I think you really would want to look for those higher yielding companies, income companies that are paying good dividends that you can rely on. You would want to go into safety, but I think all of these companies, because of the trends in place, they will continue to do well, not only if the environment gets worse, but even if it gets better, because we expect rates to remain low, so yields will be important, and also healthcare. This is now a long-term positive for these sectors.